All right, well, welcome to a special session of Canadian Tax Matters. We'll be talking about the 2025 federal election tax policies. My name is Jay Goodis, and I am the co-host of Canadian Tax Matters. With me, as always, is the sharply dressed, brilliant Kim Moody. How are you doing today, Kim?
Doing great, Jay. You're looking awesome.
Thank you very much. You're looking great as well. And we also have a very special guest with us today. I would like to welcome Jamie Golembeck. Jamie Oh, I'm sorry. Jamie is the Managing Director of Tax and Estate Planning at CIBC Private Wealth. In case this is your first time meeting Jamie, he is a regular on BNN and has a weekly publication in the Financial Post. And how long have you been writing for Financial Post now, Jamie? How many years?
Been around 25 years every week, so it keeps me on top of what's going on and always looking for new topics. Luckily, this election has given us lots of things to talk about, lots of things to write about, that compounded, of course, with our tax season that we're in right now.
Yes, absolutely. Well, thank you so much for joining us. We're really excited to hear your thoughts on these new policies and explaining what might be the outcome if they are brought into law. So I think what we're trying to take away from today is to understand the tax policies of the different political parties and how people might be impacted from the election. So why don't we just jump right in? And Jamie, maybe you can kick us off. So, since the 2024 federal budget's proposal to increase the capital gains inclusion rate, there have certainly been significant developments. Could you maybe outline the current position of the political parties?
Yeah, so I mean, this is probably the most complex, controversial issue of the last year, right? So when this was first announced, of course, 2024 for federal budget, we were all kind of caught off guard. We didn't really think this was going to happen. They proposed it, it's supposed to go to 2/3. You had complicated rules between individuals, trusts, and corporations. The first 250, then June 25th, before June 25th, all kinds of people did all kinds of planning. And then, of course, it all became nothing. Of course, we saw Parliament prorogue. We saw now, of course, the election that's resulting in all this. The bottom line is that these rules were originally deferred to 2026 and then canceled altogether. So the official position of the current government, which is, of course, short-lived because of the election, which is why we're even here today, is that the capital gains increase from a 50% inclusion rate to 2/3 is dead. So no more 2026. It's completely off the table. And that means that we've had to change every one of our publications. Jay, you've changed all your software that you do. I mean, it's been a nightmare. And in fact, that is one of the issues. And I know, Kim, you've written about the issues recently in the Financial Post about, this tax season. It's actually one of the issues that's causing a lot of the problems with the slips and the processing of returns and having to report pre and post June 25th dispositions, even though, of course, it's irrelevant because it's all 50%. So I think we have almost a good news story here. So, I mean, for those of you who, are wondering what will happen to the capital gains tax, I think suffice to say that two main parties that are leading, at least at this point, the Liberal and the Conservatives, are not going to be proceeding with this. So there's no deferral. It's not 2026. It's, who knows what could happen in the future. But their official policy position is that they are not going to move forward, and we are at a 50% inclusion rate. The NDP, of course, which has originally argued for a higher inclusion rate, would like to reinstate the 2/3 inclusion rate with the first 250,000 remaining at 50% for individuals. So again, this is something that the NDP is still hoping for, but I think that the two major parties, at least right now, that are leading in the polls, would not be proceeding with this. I think we're pretty comfortable saying that this capital gains inclusion rate is probably dead.
All right. Well, thank you, Jamie. And Kim, this is actually quite interesting because the Conservative Party has kind of suggested that we take this policy and move in the complete opposite direction. And they have proposed a Canada First reinvestment tax cut. That's what they're calling it. And it's to allow a deferral of capital gains taxes when proceeds are reinvested in Canadian assets. Could you maybe elaborate on the specifics of this policy?
Sure, Jay. And before I do, though, I also want to welcome Jamie, quite a legend in the tax community, and it's an honor to be here. It's an honor to have you with us, is what I meant to say. And as you could tell, Jay, from his explanation of the capital gains, just a well-spoken, well-knowledgeable guy. So thanks a lot, Jamie, for being here. And if I go offside on anything, I'm sure you'll correct me. So thank you. Yeah, this is an interesting one. And you're the way you framed it, Jay, I think is bang on. They're going in the opposite direction, and really what they're trying to do is take tax out of the equation with respect to certain investment decisions. And so it goes something like this: if you have a capital gain on property, and if you reinvest those proceeds in Canadian assets, then you'll get a deferral. Now, there's lots of questions about this, and the slide does talk about it. Right now, the proposal is that if they're elected, it would apply from July 1st, 25 to December 31st, 26. Very limited period, but they are on record saying that if it goes as well as they hope it does, they'll certainly extend it, which is interesting. The reinvestment scope, or what I like to refer to as replacement property. What exactly is that? What's Canadian property? Well, they're going to have to define that. And there is some precedent in the Act right now with taxable Canadian property, which I think they could just simply refine to suit, their needs. Will it impact economic growth? Yeah, and I think we've got some comments on that later. But bottom line is, it's a very interesting proposal that if it does apply, could have some significant changes in the tax system.
Okay. Well, thanks for that summary, Kim, there. So let me just ask you a question. Don't we already have some type of capital gains deferral rules in the Act today? So would this be an extension of them? How would it differ? What do you think this will bring?
Yeah, as the slide says here, we do have, Section 44, which is, if you dealt with that provision, it's a very limited use. It applies to dispositions of property that are used in a business. So if I have a building and some land that's used in a business, and I use those proceeds to replace that, as long as you meet the certain conditions of what how long it takes to apply, or sorry, to replace the property, and there's some very specific rules around that, then you could get Section 44 treatment, which is a rollover into the new replacement property. Section 44.1 is similar. It's been around for, Jesus, how long? 20 some years. With respect to small business investment shares, if you reinvest in eligible small business corporation shares, then you can get a replacement. I can tell you, Jay and Jamie, in my 30-year career, which is longer than 44.1 has been around, I have never ever used Section 44.1, and frankly, I don't know any practitioner out there that has, and I'm sure there's some, and so it's very limited use. So those are the rules. With respect to, unless you want to build this up, Jay, I can comment quickly on the U.S. if you want.
Yeah, well, I think a really good question is because oftentimes when we talk about tax reform, which I know we'll touch on, we talk about competitiveness with other countries. So do you think this policy is trying to mirror the U.S. Section 1031 like-kind exchange rules?
Yeah, I think it is. I think the like-kind exchange rules, which have been around forever, and even an average person who's not a tax specialist has heard of like-kind exchange rules in the States. It was pretty broad. If you had a capital gain and reinvested within a certain period of time, you could get a deferral. It's been narrowed significantly in recent years to real estate, but it's still pretty broad in the whole scheme of things. So yes, I do think that there is some parallels here, Jay.
Okay. Well, Jamie, let me ask you, because this is a pretty significant tax policy change. So what questions or thoughts do you have about this particular policy?
Yeah, I mean, look, of all the things we're going to discuss today, I don't want to ruin the rest of it, but I think this is the most interesting, from a pure policy perspective. This is a dramatic change in tax policy that would really change behavior. And I think it's positive. I mean, the reason I say that simply is because one of the issues, and I know we've talked about this in the past amongst the three of us, is what we often call, in behavioral finance, people have called the capital gains lock-in effect. And there have been a lot of studies on this in academia, but also in public policy. C.D. Howe, other institutes have certainly studied this. And the concern is that you've got an asset and you feel that the asset has reached its potential. Whether that's shares of NVIDIA, whether that's, some other asset or piece of real estate, and you really want to sell it. But yet at the same time, you know that when you sell it, you're going to have to pay capital gains tax. So you take someone in Ontario or BC or Quebec that's in a top rate, and you're looking at a tax rate of maybe 26%, right, on a capital gain. You know, if you're assuming that obviously the gain's bigger than top bracket gain, and you say to yourself, well, I don't really want to pay the tax, so maybe I should hold on, because the hurdle rate means that, like, if I'm selling something, like the theory is, I forget about tax. If I'm selling something, I got to replace it with something else. So unless I'm going to spend the money on immediate consumption, I'm going to replace the asset with another asset. So the underlying assumption when you sell anything is that if you're selling an investment, the replacement investment should hopefully outperform in the future the investment that you have just sold. I mean, that's the basic theory, right? The problem is that if you're losing 26% of the gain, and again, the gain could be substantial if you have a cost base of 0 on a private company share, or on one of these tech stocks that's gone up dramatically, your hurdle rate is going to be a little bit higher, right? Because you've got to overcome the fact that that tax, although it might be due one day in the future, is paid today. So you actually have the opportunity cost of paying that tax right now. What this policy would do, if it goes forward, is allow you effectively, it appears, to get an unlimited deferral, in other words, unlimited in dollar amount and unlimited in time, by simply reinvesting in Canadian asset. Now, what is Canadian? That's a great question. Like, is that a piece of real estate? Is that a Canadian company? Is it Canadian shares? We don't really know. Again, there are ways that we could define that. But look, I think it's interesting. Does the Canadian aspect have to do with the whole tariff thing that's going on? Maybe. Again, I don't know the details and the workings of the party. But this concept of reinvestment is an interesting one. I think people will take advantage of it. I think it actually will change the entire game in terms of tax planning. Because if all of a sudden now you've got a portfolio with massive gains, NVIDIA, Apple, Microsoft, like anything like that, which are non-Canadian stocks, this would be certainly an incentive to take those gains, move them over, and then start afresh with a Canadian portfolio, or at least partially Canadian portfolio, without actually paying the capital gains tax. And it seems to me that you would get an indefinite deferral of that capital gain. At least the way I read it, and Kim, you can jump in, but an indefinite deferral, which could be until death or even until second to death in the case of a spouse or partner with an automatic rollover. So look, I'm very excited by this. I think it's interesting. There's a lot of mechanics. I assume that, elections, I mean, how is this going to work mechanically? I think you'll have to file a return in the year that you do the exchange, and you'll have to, signify on Schedule 3 or something that you're going to defer it, and then someone has to track this, and then the replacement. What if you have, identical properties, and some of it is, you're buying new shares, and then you own existing shares, and some of it's subject to the deferral, and some of it isn't. Now you've got average cost, averaging with identical property. Like, I could see all the mess that it'll be complicated to administer, but in theory, I'm excited by it. I'm interested in it. I hope this goes forward. But again, there's a lot of work to be done on this, and I think there's a lot of technical mechanics. So love to hear your thoughts as well, Kim.
Yeah, I think you're bang on, but I think there's some precedent, as I mentioned, with the definition of Canadian property. I think it wouldn't take much sharpening of the taxable Canadian property definition under 248(1) to do that. Second is, I totally agree with you. If you can take tax out of the equation on any investment decision and remove that unlock, as you call it, feature, beautiful. And then thirdly is, will it impact behavior? I think it will. And so I'll leave it at that. But yeah, a lot of details that need to be figured out. But having said that, I think there's good precedent.
And that was really interesting what you said there, Jamie, about disposing of certain securities. But I do think there's a risk that we probably want to highlight to the audience if this policy were to come through. And that would be if you were to try to dispose of assets you held globally. Let's say we compare a Florida condo to what you said as shares of NVIDIA. So if that were the case and they were to say sell the Florida condo, would there be other taxes that they need to be worried about in those foreign countries?
Yeah, I mean, this is a big one. We did discuss this the other day. I mean, look, you got a real mismatch here, right? Because, of course, with U.S. real estate, or really in most countries, that country has the right under its domestic law to tax the sale of real property domestically. So, for example, if you own that Florida condo and you have a capital gain on that Florida condo and you sell that Florida condo, the U.S. has first right to tax that. You get a foreign tax credit in Canada, but in Canada, if you don't pay any tax, because you're deferring that tax for 10 years now, it appears that that foreign tax credit is gone. There are rules for carrying forward foreign tax credits. I'm not sure it works, sort of in this scenario. So that is certainly a risk. Whereas, NVIDIA shares, if you're a Canadian resident and you sell your U.S. shares, then ultimately U.S. does not tax that, right? Unless you're a U.S. taxpayer or a U.S. person, right? So in other words, because that's an intangible as opposed to tangible real estate. Kim, any thoughts on that one?
No, you're bang on. And the foreign tax credit rules, just to expand on that, are very limiting. So I think that the rule of thumb here, subject to the devil's in the details if this ever comes to light, would be if you're triggering U.S. tax, or for that matter, like you said, Jamie, any foreign tax, better be careful with that, because more than likely you're going to have a mismatch and thus expiring foreign tax credits.
Yeah, thank you for that. And Kim, I'll go to you because, Jack Mintz, who's one of Canada's top economists, he recently wrote a piece that suggests that this policy could be a big boom economically, and it could improve Canada's GDP by 90 billion and employment by 280,000 by the end of 2026. What are your thoughts on that?
Well, I do agree with you. Jack is probably the top economist in Canada, at least in my books. So whenever he says something, I pay attention and look at it. So he wrote this piece in the Hub, and it was quite enlightening. And you look at these numbers, GDP growth 90 billion, that's huge. Employment growth 280,000 jobs. Average increase of asset holding period. To Jamie's point of taking tax out of the equation, 6.6 to 9 years. So I think there's some really interesting things here to think about that could have spillover effect to Canada as a whole. So exciting stuff in my view.
I'll just add one thing on this one as well. I really think that this is very interesting just from a pure academic policy perspective, because at the end of the day, tax really does cause people to delay selling an asset that they otherwise would, which means that we have clients that have portfolios that are entirely skewed because of the recent success of some of the tech stocks. And, whereas, it was a balanced portfolio at one point, all of a sudden now they've done well than anything I've ever done in my portfolio for sure. And they're way richer than me, so I should have followed their advice. But they're completely non-diversified, right? But now if you have this opportunity now to effectively get out of some of these tech positions when it's appropriate to do so, re-diversify using, Canadian assets, in this case, Canadian stocks, banks, ETFs, things like that, without paying the capital gains tax. In other words, deferring that tax till death or until second to die of partners or spouses. I think this could be huge. And I think that's kind of the stuff that Jack was hinting at in terms of the reallocation of assets and it's really a more productive use of assets. Because if you've got, money tied up in something that really reached its peak, you really should sell it, but you don't want to sell it because you don't want to pay the tax. That's not a good reason for non-redeploying capital. So I'm pretty interested in this from a pure policy perspective.
Yeah, me too. And would that mean that this would essentially be revenue neutral for the government? Because if people are holding on to certain securities because they don't want to trigger the capital gains tax, this allows them to reallocate, but the government wouldn't be losing any money because otherwise they would have just held on to those assets anyway. So they're just going to find a more productive use of those funds versus maintaining the status quo. Is that how you understand it?
More or less. There's still obviously people that will sell, right? People will still sell because they need the money. They need the money to do something other than reinvest in something in Canada. They want to spend it on a trip. They want to pay down debt. Like there's other reasons why people, might still trigger gains. But yeah, I think that's a good point.
Okay. Thank you both. That was very interesting. And there's another kind of big policy, at least when it comes to what's going to lead to savings and what's going to be a significant amount of money spent by the government or less revenue coming in. They proposed adjustments to the lowest personal income tax bracket. So maybe, Jamie, could you compare these proposals in terms of their structure and their impact on taxpayers?
Yeah, so these are very, very similar. Look, I've actually been arguing the other side. I think that the top marginal rates are too high in all the provinces, where you're getting, more than half the provinces in Canada have a marginal tax rate above 50%, 54%, 53%. I think one province out east is almost at 55 or around 55% for high levels of income. So I think marginal rates are too high. Anything over 50% for me is disturbing from a psychological perspective, that you can't even keep half your money no matter how hard you work. But this government, and certainly any future government, both on the Liberals and Conservatives, are not looking at the top rate, at least at this point. They are focusing on something that would really benefit all Canadians. So the Liberals have said they're going to cut the lowest federal bracket by 1 percentage point. So we're going from 15% to 14%. The Conservatives said they would lower the bracket again from 15% down to 12.75%. So again, both parties, of the leading parties, at least at this point, Liberals and Conservatives, have both said that this will sort of increase the amount of take-home pay for both lower and middle income. Remember, everyone, even if you're a millionaire, you will benefit here, right? Because everyone has that tranche of income, which is what, I think it's around $55,000 or something like that at the federal level, that's taxed at the lowest rate. So this is universal, whereas if you cut one of the higher brackets, a lot of people won't benefit because most people are not in that higher bracket, right? So this is something that is universal. I would call it a universal tax cut across the board.
All right, thanks, Jamie. And Kim, what would be the potential savings from this policy? And are there any strategies that individuals should consider for their financial planning in 2025, assuming that this policy moves forward in 2025?
Well, as the screen says here, Jay, the blue Conservatives, they're computing it at $928 per person and $412 for the Liberals, which just on a pure math basis makes sense, given that it's coming down to 14% for the Liberals, but 12 3/4. So, but really, at the end of the day, and I know we're going to talk about it here shortly, but this needs to compute as well the impact of the personal tax credits in terms of financial planning. Yeah, I mean, you got to look at use of personal tax credits. There's one that I'm just drawing a blank on, Jay, that you and I were talking about yesterday. You want to remind me of what that was again? About financial plan?
Regarding Alberta? Alberta's changed to the bracket?
Yeah, because Alberta. Oh, sorry, go ahead. Actually, you can describe it much better given the fact that you're a tax template god. So,
good. So this is interesting because Alberta, in their last budget, they dropped their lower bracket from 10% to 8%. And this actually has an impact on credits as well, which I'm going to push back to Jamie to talk about the credits. But one of the things that they did is they created a brand new credit to ensure some individuals who might have significant credits, let's say significant medical credits, to ensure that they're going to be able to still get the full balance at the old 10% rate, not the 8% rate if they trickle in to the second bracket. So maybe with that, let's just ask Jamie about what the impacts to these credits will be and why it might be a little bit, misleading when we talk about the maximum amount, even though that's true, but may not apply to everyone.
Right. So this is one of the features of the Income Tax Act that I'm not sure that maybe the parties know it. I haven't spoken to the parties directly, obviously. I'm not a political person, but maybe they haven't fully thought it through, or if they have, they certainly haven't spoken about it publicly. And that is that when you lower the rate, right, and you lower the rate for that bracket, which is the first bracket, which is, what is it? Is it around 55? Let me use the right number. What's the right number? 55?
Yep. You're
55,000, right, for federal. For this is what we're talking federal today, right? So 2025, 55,000. When you lower that rate by 1 percentage point or 2 1/4, whatever you're lowering it by, it also has an automatic effect on almost all of the credits. Right? I think donations are an exception, but on almost all of the credits, because things like the basic amount, the eligible amount, we have them on the screen here, the age amount, all these various credits are based on a factor. And under the Income Tax Act, that factor is defined as the lowest tax bracket. So in other words, unless there was a proactive amendment to something else in the legislation, the impact won't be as attractive as we just saw in the previous slide, because you'll start to lose some of the benefits of these credits. So instead of getting these federal credits at 15%, unless the government makes another announcement or change, those credits will only be worth 14% or 12.75%. Now, that may not be a big deal if you only have the basic personal amount, which is, I think, the illustration on the previous slide. But there was a report that just came out this week by the C.D. Howe Institute, by authors Alex Lauren and Nick DeHere. And ultimately, they did a calculation. And they actually showed that, in fact, when you look at the tax savings, it's lower than advertised. And they looked at the massive computer database that they have access to in terms of all Canadian tax returns. And they ran simulation models. And they showed that depending on your income level, the average change in federal tax, yes, it's lower, but it's not what was actually published by the parties, simply because of the automatic effect on the credit. So I think this is an interesting study. It's available publicly on the C.D. Howe website. But this is good work. It's good analysis. And I think if this will lead, if this goes through by either of those parties, if they do win, this will lead to some redrafting. In other words, the government could say, oh, we didn't really intend this, or, yo, we intended this, and you'll just have to get, you're getting a tax break, but yeah, you get a bit of lower value on the credits. Or they could do, Jay, what you just suggested that Alberta does, is they could preserve the rates at a certain rate, or they could introduce a new sort of credit to sort of look at the average amount lost. So it's a little complicated right now, but we're paying attention to this. This is quite interesting. Of course, the bigger question that we'll get to at the very end when we talk about tax reform is, why do we have all these darn credits anyway? I mean, that's a whole nother discussion. And I think that clutters up the code. So get rid of all the credits and put just one basic amount, and then you're done with it, right? Really simplifies this part of it.
Yeah, well, thank you, Jamie.
Jamie Golombek for finance minister.
Well, let's talk about the NDP for a moment, because the NDP has their own suggestions on what we should do around the basic personal amount. So, Jamie, do you want to update us what their policy suggestion is?
Yeah, absolutely. So the NDP really, of course, focusing on lower income. That's typically been, what they've looked at, and trying to tax higher income, which is exactly what's happening on this slide. So they want to bump up the basic amount to $19,500 for anyone who has income under the fourth bracket, which is $177,000. So increase that basic personal amount, as long as you're income under that, to maximum of savings of about $500 per person. If you're in that fourth bracket, in other words, anywhere from $177 to $235, reducing the basic amount to $13,500. That'll cost about $400 annually. And of course, if you're in that top bracket, $235, a complete elimination of the basic amount, and that will cost the wealthiest people about $2,000 a year per person. So, this is consistent, I think, with NDP's tax policy over the years, which is really trying to reduce the tax burden for lower and average Canadians and trying to increase the tax rate, as we saw earlier with the capital gains proposal from the NDP. They would like to bump up the inclusion rate to 2/3. Similarly here, they like to take away the basic amount for anyone in the sort of top bracket. I guess the argument is they don't need it. But then there's, of course, the counter argument of universality. In other words, if every Canadian should get a certain amount that they can earn tax-free, why should people with higher income be penalized as well? So again, you get into this sort of fundamental debate, but this is kind of the NDP proposal.
All right, thank you, Jamie. And if we share a little bit about how the tax system works now, we do have something called the enhanced basic personal amount. And currently how it works is once you get to that fourth federal bracket, it starts to reduce until you get to that top bracket. So there is a bit of the basic personal amount that's not available to those who are at that income level. And interesting enough, recently, the province of Manitoba, they came out with a very similar policy to what we see on the screen here, is that as your income grows, and once you get to over $400,000, you fully lose the basic personal amount as well. So the NDP has certainly drawn from that policy a little bit too. All right, so let's maybe change gears here and talk a little about some GST on new homes. So both parties, I think, are looking to try to improve housing affordability. So Kim, maybe you could provide us some detail of these proposals and their impact may be on the housing market.
Sure. It's a pretty straightforward one that's on the screen here. Both parties, the Liberal and the Conservatives, want to eliminate GST on new housing. And so the key differences between the two parties is the Liberals want to eliminate GST on up to $1 million of cost. The Conservatives 1.3 million. And so you'll see on the screen there maximum savings of 50,000 for Liberals and 65 for the Conservatives. But the key difference here, Jay, besides rates, is the Liberals want it for first-time buyers only. So, and the Conservatives are across the board. So when you think about that, that's interesting, right? Because certainly a narrow group for first time, but for everybody, it's a much broader audience. So that is the broad proposal on GST relief.
Yeah, well, regarding the proposed GST exemption on these new home purchases, how might this apply to pre-construction condo projects that might be happening right now? Like, what considerations should buyers and developers keep in mind regarding the timing of this policy's implementation if either one of these parties, wins the election?
Yeah, it's a great question, and frankly, I don't, unless you guys have an answer, I don't have an answer in terms of what it is. Is the relief going to be provided upon actual closing, or can it apply right now during construction? And so I think that key timing issue needs to be looked at. If I had to bet, I'm gonna hope at least anyhow that it's on closing so as to get that relief, but really don't know. I don't know if you have
Okay.
anything to offer on that, Jamie, but that's kind of my two-cent thoughts.
Nope, haven't heard.
Yeah,
Yeah.
and it will certainly be interesting from a timing perspective, because if we have these condos coming to market in 2025, the timing of this policy, along with the timing of when these developers actually put the closing in place, this could lead to significant savings for home buyers if it's put in place. So it's something I think that anyone looking to get into the condo market or the developers will probably be monitoring closely following the election. So Kim, on the current screen, we have a Liberal Party has introduced the multi-unit residential building policy called the MURB, and this is to address housing shortages. Could you maybe explain the mechanics of this policy and maybe provide historical context on similar initiatives in Canada? I know you wrote a great article on this in the Post on April 9th.
Yeah, thanks, Jay. I'll just maybe start my comments by saying I'm not a huge fan of tax shelters, period. But having said that, this goes back to the 1970s, and it was designed because, of course, there was housing issues back in the 1970s as well. There's a shortage. And so one idea was, well, why don't we try to get, investors to help build multiple unit residential buildings? And so the idea was investors put money into a partnership, and that partnership then builds these units, and the investors will get accelerated CCA flow-throughs because it's a partnership. Because most people on the line here probably know, Jay, that building CCA right now is at a 4% declining balance rate. But back then, there was some incentives put into anywhere from 40 to 60%. So you could actually create rental losses in these partnerships, which were then flowed out to the investors. So the investors in many cases were creating significant losses by these investments, and ultimately deducting it against their other sources of income. And so, as I mentioned in the article, there was 200,000 roughly units built back then, but it was questionable as to whether or not it was helpful. And there are some behavioral impacts in terms of having investors just simply investing for the tax write-offs. And so the program was killed in 1981 for new projects. And ultimately in 1987, it was phased out for those existing projects as well. And that's right around the time I started in tax, Jay. It was about 1987, 88. And the phase-out period, I think, ended, if I recall, in 1990. And I think Jamie is roughly the same age as me, so I think him and I, dealt with these a little bit towards the end of our, beginning of our careers, what I meant to say, and they're complicated. So the bottom line is, the Liberals propose to revive something like this. Now the devil's in the details. Maybe they'll design something that takes into consideration some of the criticisms that I pointed out in my article of April 9th, but I guess we'll see. So there you go.
Okay. All right. Well, thank you for that quick history lesson there. Sometimes, what's old is new again. So it'll be interesting to see what happens here going forward. So Jamie, both major parties have proposed changes to RRSPs and RIFs, and also some slight changes to the GIS. Could you maybe outline these proposed changes and offer advice to individuals on how to navigate them?
Yeah, so this is an interesting. This comes up over and over again. It's come up, and I think back in 2008, it did during the economic downturn and then the stock market meltdown. Then it came up during COVID. So the issue, the fundamental issue, and this has actually been studied by Parliament and special committees, and reports have been issued about this issue of what is the right time, what is the right age ultimately to force people to cash in the RSP. Now, some people say never, right? And there's been academic studies saying, why should you ever have to cash it in? Let it just grow, and then when you die, you obviously don't need it for retirement, and then you pay your tax. The government says, no, we want our revenue. I mean, that's the bottom line. Like, there's no other reason from a policy perspective to force people to cash in their RSP or RIF, starting at age 71 right now, other than the fact that the government wants to recoup the revenue they never got when you put the money in there, right? Like when you make a $30,000 RSP contribution, you're deducting the $30,000 from your income. The government's losing as much as 53% of it or 54% of it, and the government wants the money back, right? And therefore, the government has put in a forced withdrawal system, which everyone knows starts at age 71, or the year you turn 71, you've got to convert the RSP either to a RIF or to a registered annuity, which some people do, very few people do. Most people use the RIF, which is really the opposite of the RSP. There's a minimum amount that you must take out each year. There's a prescribed schedule, starts at 5%, goes up to 20% by the time you're 93, and it forces people to take money out, which is fine, except if you don't need the money. And so the argument has been for years from a pure policy perspective is why should we force people to take money out of their retirement, pay tax on it now, and then just reinvest it if they're not spending it? In other words, reinvesting it in a protected way. Yeah, some people can put, maybe $7,000 into their TFSA, but other than that, you're basically forcing them into a taxable account, which will start to erode, especially as people start to move into fixed income, which is highly taxed. It'll start to erode the value of their retirement savings. So the Conservatives are saying, let's bump up the age to 73, and that was actually something that was proposed many years ago, right? Let's convert from 71 to 73. Of course, it was at 69 at 1.2. People are living longer. The money should last longer. People have longer retirements. And I think that's certainly something that would be attractive. The Liberal plan, I think, is in light of recent market and things like that, is to temporarily reduce the minimum that you got to take out of your RIF this year by 25%. So again, we've seen that RIF 25% reduction. We saw it back in 2008. We saw it again in 2020 during COVID. But the issue then is in the details, right? Because if you've already taken out your RIF minimum this year for 2025, so some people take it out in January and they don't worry about it for the rest of the year. A lot of people take it out monthly. And then some people wait till December to take it out, right? Because the money is simply growing tax-free. I'm talking about people who take it out if they don't need it. Like if you need it, obviously you're going to take it out when you need to pay your rent or need to buy groceries, right? But I'm talking about people who take the money out that don't need to take it out. So I think the practical advice here is stop taking money out of your RIF until you find out what this proposal is. So if the Liberals win and they move ahead with this, and you've already taken out the RIF minimum, we saw in 2020 in COVID, people were upset. They were upset for a variety of reasons, but they were also upset about this. We got a lot of emails from seniors saying this is unfair because they proactively took the RIF minimum in January, and then when they introduced in March of 2020 the reduction, it was too late for them. Now, we've had precedent for people being allowed to put the money back in. That's messy. That's complicated. So, I think from a practical perspective, if you can hold off, a couple weeks until the election and then wait maybe a month till we have a budget and see exactly how this measure looks, you might want to do so rather than taking out, because then you could, again, if you don't need the cash, then you can allow the money to grow further. And the other thing, again, I just mentioned briefly, is the Conservatives would, in theory, if you go to 73, presumably give you 2 extra years to contribute, right? So in other words, if you don't have to collapse your RSP till 73, then ultimately maybe you can contribute for 2 more years if you have earned income. Earned income, of course, employment income, self-employment income, like business income, but also rental income. People forget that. So rent, if you have a rental property, you're renting out your basement, you've got a secondary suite, or you're renting out something, then ultimately that could qualify you to make some extra top-ups to the RSP before converting it to a RIF. So, this is interesting stuff. Yeah, small proposal on the GIS as well. Again, another $600 for the lowest income Canadians. So that's certainly a part of the Liberal plan.
Great. Thanks, Jamie. And that's a really interesting policy discussion regarding the RIFs and whether or not there should be minimums or not. Because, one of the projects we have internally right now is on decumulation, which is, I know, something you work on with your clients a lot. And oftentimes you want to take out a certain amount from those RIFs every year. So you're not stuck with that big tax bill in the year of death, even though you may get the deferral. So there's a lot of math happening there. So I do think that would be a very interesting policy discussion. And practically speaking, is it really required and how many people are impacted by it? But we'll save that for another day. Let's move on to the policy to increase the TFSA contribution limit by $5,000 for investment in Canadian businesses and assets. And this is another meaty proposal. So could you maybe explain this initiative? Is it intended to be as a one-time adjustment, or do you interpret it as being an additional $5,000 every year?
Yeah, I think it's $5,000 a year. I think this is a conservative proposal, right?
Yep.
So the idea is that in addition to the $7,000, which you can put in, you'll be able to put in another $5,000 every year as long as you invest in Canadian investments. What is Canadian? Again, we have that same discussion that we had earlier, Kim. It could be taxable Canadian property. When researching this last week, there's actually another definition as well of Canadian investment property in a very small part of the act that no one reads unless you're a life insurance company. There's rules for life insurers and what is considered to be a Canadian investment property, which lists things like stocks and bonds and things like that. So that's another possibility. But this is interesting. I think it's messy. Do you need a new TFSA to track it? Will it move money over from existing? I think it's messy. It's interesting. I'm all for giving people more, tax-free savings opportunities to allow them to save for themselves as opposed to relying on the government. But yes, I think this would be an annual additional $5,000.
All right. And Kim, do you want to talk about what you think that definition of Canadian investment property might be?
Sure, Jay. I do think that they'll likely take 248.1, the definition of taxable Canadian property, and carve it up. For appropriateness. Obviously, they'll work with the financial institutions, probably gurus like Jamie, to figure out what's the easiest to do. But I think the vast majority of investments would likely be Canadian securities, and make it quite clear that Canadian securities are eligible for this Canadian top-up. That would be my guess, Jay. So we'll see.
Okay, well, Canada used to have some foreign content restrictions for registered plans. Do you think that is this new TFSA Canadian top-up? Do you think that's in the same vein?
I think so. Certainly there's historical context and precedent to take a look at. And my guess would be that the Conservatives looked at this when they developed this policy. That would be my guess. But as the slide says here, we had foreign content limitations all the way from 10 to 30% from 1971 to 2005, when it was altogether eliminated. And I'm not an investment expert, but I think Jamie's more than I am. But certainly, one can argue whether or not this is a good investment decision, given that Canada is such a small country in the whole scheme of things when you compare worldwide GDP. But having said that, is this interesting, using the word that Jamie said? Yeah, I think it is. And so we'll see what happens, I guess.
I'll just comment on that. I mean, the reason for the elimination, and again, there was a lot of lobbying that was going on. I was back at a mutual fund company back in the days when the ways went from 20%, and then people got excited. It went to 30%, and and the argument ultimately was that Canada, at least at the time, I haven't seen the latest number. I can't be far off. Represented only 3%. Right, of the worldwide opportunity in terms of investments, and do we really want to force Canadians to put 100% or at least even 30%, a significant portion, 70%, right? I mean, because remember, this was the foreign content limitation. So if you had retirement savings, which for most Canadians is really the bulk of all they have, like the average Canadian has no non-registered investments. Maybe they own a home, which will be principal residence tax free. Maybe they have an RSP, now they have a TFSA. So do we really want to force people to have, 80% or 70% of their entire retirement savings in only 3% of the world's economy? And that's ultimately why it was scrapped, right, in 2005. That was 20 years ago. So here we're bringing it back, but I think it's different this time, right? Because here we're only talking about 5,000. Now, I say only. 5,000 is a lot for people that aren't even maximizing their current TFSA. But I don't think that the 5,000 requiring that to be in Canada would overly skew someone and put them at a disadvantage from an investment perspective. Because again, depending on the broad scope, remember that the maximum cumulative that you could be putting in, ignoring any growth at all since 2009, is now 102,000. So 5,000 on 102, it's not even 5%, right, of your portfolio going into Canadian. So again, the other thing I think that we have to think about is, will this also, work into some kind of reallocation? In other words, people will take, stuff that's already invested in Canada, put a new 5,000 into Canada, and then switch the other one back into, global. So you haven't really accomplished anything, right? So it's interesting. Yeah. We don't know how it's going to work. Do we need a separate TFSA for this? We don't love that as a financial institution to have yet another registered account on top of RSPs and RESPs and RDSPs and new FHSAs, and now we need a TFSA CAN and a TFSA Global. Like, I don't know how it's going to work. A lot of questions here, but look, I'm all for it. Give me tax-free money. I'll take it.
Your financial institution would love it, wouldn't it?
We'd love the opportunity to put another 5,000. Absolutely. It's great for the clients, right? It's great for Canadians.
I'm just bugging you. So.
Administratively, right? Like how much work is going to go into this in terms, now it's probably easy to determine from a CUSIP number, like what is the actual investment? Is that Canadian or not? Great. But how is that going to be monitored? And who monitors it? And is it a separate TFSA? We actually have no idea.
Yeah, makes sense.
Well, I have a question about that, Jamie. I have another question about how it could be invested. But the first one is do financial institutions in Canada currently offer investment vehicles that are predominantly Canadian, such as portfolios of Canadian securities?
Oh, sure. Absolutely. Yeah, for sure. Absolutely. We have many Canadians that are very interested in investing in Canada, but they often do it, for example, on equities because of the Canadian dividend tax credit. You get a very substantial tax rate. Top rate in Ontario, we already threw around, was 53.5% for income. But for Canadian eligible dividends, it's only 39%, right? So not as good as capital gains at 26, but it's pretty good, right? So we have a lot of clients that are looking at dividend portfolios. You can invest in Canadian dividend ETFs, bank ETFs that produce Canadian dividends. So absolutely, there's a wide range of mutual fund products, ETFs, solutions that are completely Canadian.
Okay, so that's very positive because it's a very smooth transition that way. I guess my follow-up question to that would be do you think a policy like this might incentivize and create the opportunity to maybe invest outside of public securities, maybe more in small businesses? Because Jamie, you and I discussed at one point how there's not a lot of TFSA investments that are maybe CCPCs, for instance. Could that maybe lead to more investments in those types of businesses?
I think in theory, yes. In practice, no. I mean, most, if not all, I think there's only one small trust company in Alberta that actually even allows a TFSA to invest in a small business corp. And that's purely from an admin perspective. Because the dollar amounts are so small, trying to qualify that small business corporation to meet the definition that it always works, and you've got to look at the financial statements and evaluate, like it's very messy. So most institutions, certainly all the banks, and all the major trust companies, all the major investment dealers, self-directed, do not allow private CCPCs, even though the Income Tax Act does permit it, do not allow CCPCs in a TFSA. They will in RSPs in certain situations, but getting an extra $5,000 in a Canadian, I don't think that's going to be a changer, just because it's an admin issue. It's not a legal issue.
Just to add to that before we move on, Jay, I totally agree with that. I know our firm on the law firm side gets asked to provide legal opinions on eligibility for CCPCs. And it's so messy and it's so complicated. It's surprisingly complicated. I think the average person, average tax practitioner doesn't have an appreciation for how complicated it is. We pretty much will dismiss providing opinions because of that, because the work is tremendous and it's usually a question of fact. So anyhow, I know we're running out of time, so we better move on.
All right, sounds good. That was a very lively discussion on what I think is a very interesting proposal. So thank you both for that. So Jamie, the Conservatives have proposed increasing the tax-free income threshold for seniors. Could you maybe provide specifics on this proposal and what it might entail?
Yeah, so this has got a lot of media coverage, but I don't think people fully understand that it's a very limited benefit. So what they're trying to say is for seniors, you can earn $34,000 tax-free. Well, look, they can already earn most of that tax-free already, right? And what they're effectively saying is, look, every Canadian, unless you're higher income, as you alluded to earlier, Jay, with the clawback of the basic personal amount, but basically every Canadian gets about $16,000 already tax-free. And then, of course, if you're 65 or older, unless you're clawed back on the age credit, you get another 9. So let's add the two together, you get about 25,000. So what this is really saying is that we'll give you another 9,000, but it's not really 9,000, right? Because if you actually read it, it's actually 9,000 of employment income or self-employment income. That basically it's for working seniors. So, which is fine, because a lot of people work beyond age 65. They have a part-time job. They're doing some consulting. They're driving for Uber. Like, there is some source of income. So yes, I think it would certainly be beneficial. But again, if you read the wording of this particular proposal, it talks about working seniors. And I think what they're hinting at is that that extra $9,000 of tax-free income for a senior would have to be in the form of employment or self-employment income, and cannot be like interest income on your GICs or dividend income on your bank stocks.
Okay.
So are you saying, Jamie, that when I retire, that I can go and work for Walmart, for example, and earn an extra 10K? Because if so, I'm doing it.
You're all in. Absolutely. You'd be a great greeter, by the way.
Oh, thanks.
I think you've already got the jacket. Is that the Walmart jacket?
It might be, yeah.
Okay, well, Walmart, if you're
AC/DC.
listening, Walmart, if you're listening, please send something to Kim Moody. If you need his address, please let me know.
Yeah, absolutely.
So regarding that policy, Jamie, it's really interesting. Quebec actually has something similar in place, so they maybe drew from that for inspiration. And from a planning perspective, as people are working longer, it also might change some of the strategies from corporations. So if someone has a corporation, they might be on a dividend strategy. If they're over a certain age, maybe at some point, they maybe pay a little bit of salary. So Kim, both major parties have suggested measures to support tradespeople, such as deductions for travel expenses. Could you maybe quickly elaborate on these proposals?
Sure. Both these proposals are pretty much copycat proposals, and they're focused on, I think off the top of my head, it's 81T of the Act, and which allows for deductions for meals and travel to the extent that you have you're away from your normal municipality, and it has to be more than 150 kilometers. And current law is that the annual ceiling is $4,000. And so what both these proposals are doing, the Conservatives and the Liberals, they both want to bring that 150-kilometer threshold down to 120 to make it easier to claim. And the Conservatives want to lift the $4,000 ceiling so that if you're away and you're incurring all these expenses, then of course there's no ceiling. And the Liberals want to ultimately study with industry tradespeople and see what that cap should be. So that, in a nutshell, Jay, is the proposal for there.
Okay, and I'm not going to push the hot potato topic to either one of you today, but from the carbon tax perspective, to keep it very high level, is that the Liberals and the NDP are looking to eliminate the carbon tax, the consumer carbon tax, and the Conservatives are looking to eliminate both the consumer carbon tax and the industrial carbon tax. Right now, the carbon tax is at 0 for consumers based on a change in the regulations for anyone who's really interested in how the whole system works. And otherwise, we're going to jump right by that one. Kim, could you maybe talk a little bit about this GST on Canadian-made vehicles proposed by the Conservatives, and what would qualify, do you think, as a Canadian-made vehicle under this policy with all the back and forth between Canada and the US when building cars?
Yeah, this is an interesting proposal. Not sure how much impact it'll have, but it's certainly in response to, the tariff threats from the United States. And ultimately, the proposal is if you buy a Canadian-made vehicle, uh, then ultimately the GST would be eliminated on that. So the obvious question is what might qualify? Is it final assembly in Canada could be the primary requirement, are there some implementation challenges? Absolutely. I mean, how are you going to qualify that? How are you going to distinguish? If I go and buy a vehicle, which right now I am in the market for a vehicle, you know, and I go to my dealership and say, hey, I want the Canadian made one. Can they answer that question accurately? Certainly not today, they can't. But as the slide says here, maybe the potential identifiers could be done through the VIN system, where maybe you, for example, have a VIN starting with the number 2, and that shows you that it's Canadian. So maybe that's a solution, not sure. But at the end of the day, Jay, there's a ton of outstanding questions on this proposal. We'll see where it goes.
All right. Thank you, Kim. And Jamie, the NDP also have some policy recommendations for GST. Could you maybe quickly walk us through them?
Yeah, again, we've got them just listed on the screen here. We've got your vehicles, you've got, cell phone, internet services, prepared meals in grocery stores, essential utilities. So look, it's all beneficial. And, to the extent that you're going to save 5% on a broad range of goods and services, again, we can get into a big policy debate, which we don't have time for today, on, in fact, should GST actually be increased and income tax decreased? In other words, as a source of revenue, that's a whole nother discussion.
All right.
If you'd like I'd love to get into that. That'd be fun.
There we go. If you'd like to see a webinar with Kim and Jamie debating income taxes versus GST, let us know, and maybe we'll do that one in the future. All right. Well, that actually flows nicely into our next slide. Kim, you've been a very vocal proponent of Canadian tax reform. The Conservatives have proposed establishing a tax reform task force. If that were to happen, what would be the mandate of this task force, and what outcome do you think we might anticipate?
Well, just a little context, which is provided by the screen here, Jay. The first and only time that Canada has broad-based comprehensive review of our system was the so-called Carter Commission, which was convened by then Prime Minister John Diefenbaker, who's the top picture there. It was a 4-year period, and they released their report, which is frankly it's still aged rather nicely today. There's some things that certainly haven't, but for the most part, it's aged nicely. 6-volume report. It was kind of the impetus and a lot of debate in terms of politically after that time, but it was the impetus for broad-based tax reform which was implemented in 1972, January 1, 72. We've had limited reform since that time, Jay, like the Mintz Committee. We've had 1986 Wilson reform, which was kind of interesting but not pervasive. But since that time, nothing. I'm a purist, Jay, as you probably know. I'd love to see another Carter Commission. And I get criticized for that view because people say, what are you, crazy? Well, yeah, maybe I am, but I'd love to see broad-based review. Just take the time that it needs because it's so bloody complicated. But politically, we're just not there. The environment is not there, and I recognize that. So to answer your question, Jay, what do I think this could do? Number one, I like the idea, because we do need some reform, no question about it. I call the Income Tax Act a patchwork quilt of changes since 1972, and it's complicated, as we on the line here know, and probably lots of people on the line know that. I think the objective, Jay, would be to look at obvious things that can be done to clean up the act, simplify. Number two, provide some economic incentives, which in my world means reduced personal tax rates, like we talked about, and look at competitive corporate tax rates, maybe corporate big ideas like Jack Mintz has floated about a corporate distribution tax regime, which I think is rather interesting. And then overall, just see whether or not our international tax policies need some cleanup. So I think that would be the overall objective, Jay. I don't see this task force lasting probably more than 6 months, but we'll see what happens.
Okay, thank you. And Jamie, as we lead up to the election, there are still several key tax policies that remain in limbo. Are there any of these policies that you're monitoring closely, and have any of the parties provided clarity on any of these outstanding issues?
Yeah, look, I have to assume that all these will be fixed up, just administratively by the end of the year. I mean, depending on who wins. I don't think that these are overly controversial. But, there's still some uncertainty there. Most of the AMT stuff is already law, the changes. But there's a couple of new proposals there that haven't yet passed. Those will probably be cleaned up. And then, of course, the whole the Bear Trust fiasco, which we will not talk about today. Again, that's still in draft form. But I suspect that will probably proceed as well. And there's a whole bunch of other stuff that you see on the screen here. But my suspect is, depending on who wins, I think this will all be pushed through legislatively, hopefully by the end of the year.
Okay, thanks, Jamie. And in light of the changes to the economy, specifically with tariffs at the moment, do you think that we can expect to see more changes to tax policy during this period of uncertainty? And if so, what policy do you think we could see?
Well, look, I mean, I think, anything can happen, right? I mean, we're in a very uncertain time. The tariff stuff seems to change by the day, if not by the hour. And we really just have to stay on top of it. I mean, I think that's the thing. It's hard to predict what will happen. I mean, we know there's an election coming in Canada. People do have a choice of all the various parties. And we'll have to see, as a majority, minority government. I think there's a lot of uncertainties right now in Canada. And, of course, how we're dealing with the U.S. So ultimately, I think people just have to, pay attention, follow the news, and vote. I think that's the most important thing. Vote. I don't care who you vote for, but make sure you vote.
Yeah, totally.
All right, thank you. And Kim, maybe what I'll do is I'll leave the last question to you before we get to some of these audience questions we have here. But between the federal election, tariffs, and tax seasons, I think a lot of people feel like they need a drink. So why don't you just wrap us up with any information for changes to alcohol taxes?
Well, this conservative proposal certainly is going to make my wine cellar larger, that's for sure. I'm kidding, obviously, but what a lot of people don't understand with alcohol is that there's federal excise taxes, and ever since 2017, there's been an automatic inflation adjusted indexation escalator mechanism. So depending on what the CPI is, it automatically will adjust upwards. And so that frankly flows down to consumers of alcohol, which I think is a good chunk of Canadians, and therefore adds day-to-day costs. What the proposal is that, and by the way, that escalator happens automatically every April 1st. So just a few weeks ago, Jay, my wine cost more. And so bottom line is what the Conservatives are proposing to do is remove that automatic escalator and bring back the excise tax levels to what they were in 2017. So just a short little consumer-based proposal, I guess.
All right. Well, thank you, Kim. And if you want to hear more of Kim's policy insights, he's got some great articles regarding the election. And I also highly recommend reading Jamie's post as well in the Post, because he's got some fantastic articles
Who
of
the
what's
hell are
happening in the
these
tax
guys?
world. Yeah. Yeah. I think you and Jamie turned out really great in these photos. This is fantastic. Well, what I want to do is I just want to first thank you both for your incredible amount of knowledge regarding tax and helping us understand what these policies are and where they might go. For the audience, for everyone who joined us, thank you. Kim and Jamie have been very generous with their time, and they're going to stick around for a few more minutes to answer some of the questions that have come in. So why don't I just jump right into them if that's okay with both of you?
Absolutely, yeah.
All right. First off, Kim, if you could wave a magic wand and delete a specific piece of legislation from the Income Tax Act, what would you change or have disappear?
Oh boy. Well, TOSI comes to mind. That's number one. Yeah, I'll leave it at that. TOSI is such a ridiculous piece of legislation. It's overly complex. I've never seen an audit on it. I don't know if any practitioners on the line here have seen it, but it just adds unnecessary complication for minimal revenue. And frankly, I don't think it's fair, not in the least bit.
All right. Jamie, did you want to give an opinion there, or should I jump to
I
the
was
next
going to
question?
say, I was going to say the same thing. The tax
Oh,
on
good.
split income, it's so complicated, and the forms they created are absolutely illegible. I mean, it's just incomprehensible, I would say. And I'm in this
All right.
business.
All right. So regarding the deferral of the capital gains tax, does that mean taxes are still going to be paid later? Like they're still going to be due? And if it's deferred, do you expect there's going to be a change to the ACB of the new security? How do you think this might work?
I mean, we don't know, but my guess is the ACB would carry over, right? So you'd have an ACB, you'd carry it over to the new property, and then ultimately, whenever you sold it, you'd pay tax at the rate, at the inclusion rate, in effect, on the date that you sold it. That's my guess.
Yeah, there are some precedents here. Like if you've ever dealt with a Section 44 rollover, which I have a number of times in my career, sometimes what you'll end up doing is filing the return, um, and the replacement property is not yet purchased. And so ultimately you would file the return depending on when you've acquired it, or sorry, disposed of it in the year. And so you may end up adjusting the previous year's filing to recover the taxes. So again, I agree with Jamie. Devil's in the details. We'll see what happens.
All right, thank you. Miranda has a very interesting point when we were talking about the credits and the credit rates and the impact to say, let's say the age credit, the disability amount. So instead of giving those credits a different rate, another option the government could do is they could increase the amount of the actual credits. Therefore, it would come out to the exact same result. So instead of a credit being 15,000, maybe they jump it to 17,000. So the impact would still be the same. So that's a very, very clever
Yeah.
way of thinking about it.
Yep.
Yeah, yeah, it's a good point.
Okay, a question here regarding, I don't know if, regarding corporations that buy homes, say a small business owner has to shelter the property inside a corp, will they still be subject to the GST on these new purchases of homes where there could be a exemption of up to 1 million or 1.3 million? What do you think will happen there? Kim?
Well, if I was a betting man, I would say you're probably not going to be eligible for it. But I could be wrong on that because if the intent is to broad base increase, for example, rental housing, then maybe. But off the top, I'm going to think probably not. But I don't know. I might be wrong on that. Jamie, what do you think on that?
Yeah, my guess it would be, again, I'm not a GST expert by any stretch, but I mean, I think the intention is for individual residential property, and most people own that, if not 99% of people individually. So I wouldn't be surprised if it's for individuals.
Yeah, I can't remember offhand, but I remember looking into something like this a few months ago regarding certain rebates for GST for homes up to a certain amount. I believe the threshold's around 400,000 or so, and I believe that if someone were to purchase a property and the intention is for a long-term renter, they can still get access to potentially that rebate. So I wonder if those rules will have to be considered in light of this change, which would impact, corporations. Regarding the 34,000 tax-free amount for seniors. So we know that we get about 25,000 of that will come from the basic personal amount and perhaps the age amount. So the question is, could that 9,000 extra earned income, could that already be, included from GIS? So if we already have clients who get some GIS, will this impact them at all? Jamie?
It could, right? I mean, this is a question, right? So ultimately, that $9,000, part of that savings, again, we haven't seen the math, but you're supposed to be able to earn 34,000, right, tax-free. So, ultimately GIS is income tested, right? So you lose GIS, I think 50 cents on the dollar. So we don't know. I mean, all we have is a one pager, right? That says 34,000. So it could be anything. It could be a factor of, no tax on that extra 9,000 as a credit, or it could be impact of not reducing someone's GIS for employment income between, 25 and 35,000. Don't know. My guess is that GIS is not involved. That's been taken out of the equation, and then it's just an additional working income credit for 10,000 of employment income. That's my guess.
All right, thank you, Jamie.
I would guess the same. If I could just chime in on that, Jay, real quick. My guess is, and I don't know this for sure, obviously, but my guess would be on certainly the Conservatives' proposals, which are the very meaty proposals that we've talked about today. A lot of the technical details that we've kind of mused about, I'm sure will be pushed to this tax reform task force to deal with. That would be my guess. But who knows, I guess.
All right, thank you. A question here is, have any of the political parties shared whether or not they're considering taxation of principal residency and impact on principal residency exemption?
No one said that. No one would dare say that. At least not when they haven't been elected yet. Now the day after is another story, but no one said anything.
Okay, good. I didn't hear anything. I just want to confirm with both of you. All right. Several people are asking for the slides. Just so you know, the slides are available in your Canadian Tax Matters account. You can just log in, click on the course, and the slides will be available for you. I do have several comments who are quite interested in a policy debate between Jamie and Kim regarding GST and income tax. So we might have to put something in the calendar.
I'm going to guess that we would agree on most things. That would be
I
my
think so
guess,
too.
but I could be wrong.
I appreciate this might be slightly outside the tax realm. So if it's outside your comfort zone, that's okay. But someone's asking if the conservative government were elected and they eliminate capital gains, do you think that'll have any impact on the cost of housing? I think they're referring to the point earlier about that there might be a reallocation of capital, and that could that generate some more supply on the market?
For sure, for sure. It'll have huge. I mean, if it really goes through as planned, that you can sell your cottage, vacation property, secondary rental property that you're renting out right now for no capital gains tax because you're investing it in GICs, which is apparently what it reads, then absolutely people will start selling all their secondary residence income properties and allow the market to rebuy them at fair value. So I think absolutely will have a huge benefit on the real estate market.
I think a debate on that though, Jamie, would be, and there's some hints about this in the release that the Conservatives, if when they define what Canadian property is, I have a suspicion, and again, I could be wrong, that securities will be part of this, but maybe more passive assets like bonds or GICs may not be. Because I can see an economic grind to the extent that you have a cottage disposition that all of a sudden is invested in a GIC. Like, how is that helping the overall Canadian economy? One would argue that it might indirectly. But I could see something being carved out for that. But again, I'm just musing. I have no inside knowledge on this whatsoever. We'll see, I guess. Devil's in the details, as they always say.
Yeah, I would just comment on that one specifically. I mean, GICs ultimately, right, are offered by banks and institutions. What do they do with the money?
Yeah.
They don't just sit on it, right? They go out and lend
They
it out.
don't?
No, they lend it out as mortgages, right? That's how banks make money.
Right.
So there are two
forgot.
sides of it.
Yeah. It's
Going
a good
back
point.
into the economy, right? Yeah.
Yeah, very good point.
Yeah, and this actually feeds nicely into one of our last questions here about regarding the reinvestment into Canada. Do you think that it's going to include the ability to invest in public securities as well? And will there be limits on it? For instance, do they just want them going into, blue chip stocks on the TSX versus maybe some of the other opportunities, whether it be other CCPCs or public corporations, or do you think it'll just be a large band and it can go into either one?
Well, Canadian, right? Like any Canadian investment. So if you look at the definition of taxable Canadian property, like private company, public company, any Canadian company.
Yeah, I would agree with that. I don't think the Conservatives on this proposal have any desire, I could be wrong, but any desire to put a ton of precision on what Canadian assets is. That would be my guess. That would just add unnecessary complexity and limit the ability for impact that I think they're trying for. I could be wrong, but that's my guess.
All right. And
I
the
got
last
a lot. Oh, sorry. Go ahead, Jay.
No, please, Kim.
You've got a last question, but because I want to make my question the last question. So go ahead, Jay.
Okay. So the question I generally have here, and it can go to Jamie and Kim, and maybe in a different way based on your roles in advising clients. But what are you recommending to clients right now as we go through this period of uncertainty, which with a new federal election, possibly tariffs and tax changes? What are you advising them, and how are you getting them prepared post-election?
I mean, I'll just say, just in 30 seconds, I mean, I think it's most important is to get advice. I mean, I think this is really what we tell our clients every single day. This stuff is complicated. We don't know what's going on. We've got experts that certainly have seen these type of things before, although maybe not at this sort of trade war type level. But, work with an advisor. I mean, I'm a big fan of that, whether it's a financial advisor, an investment advisor, a tax advisor, a legal advisor, because they've been through it before. They've seen other scenarios. They see what other clients are doing, and they'll be able to really steer you correctly in terms of a portfolio, not to make rash decisions, and to look at the big picture. It's not just tax, right? It's investments, it's retirement. People have different goals. People have different, desires of spending and how much they want to leave in inheritance. So each situation is so different. But again, if you're working with a trusted advisor, I think you're going to be okay.
I would just add to that, Jay, the key word in my realm is flexibility. And you know, when you asked the question, there was, you know, the thoughts went back to the capital gains debacle of last year, right? The 2024 stuff, and we had people racing to trigger capital gains. When people approached us on that, we always gave them a lot of caution. Hey, you can go ahead and monetize and liquidate your portfolio if you want, but you might want to consider doing X, Y, Z to provide flexibility. I've got, you know, one close friend who chose not to follow that advice and monetized it all, and I can tell you he's kicking himself today. So I think the key word is flexibility.
Okay. Well, that's wonderful advice. And, you know, Kim, I think you said you had one more question, so I'll let you go ahead and
Yeah,
do
so
it and wrap us
Jay,
up.
I think this slide was generated by artificial intelligence on your end, you know, for Jamie and I. And I just have to point out that Jamie has more hair on his in real life, and I've got less. So I guess my question to you, Jay, is did you hire a professional artist, or is this indeed manipulated AI? Because I think I look a little better in real life, don't I, Jay? Come on.
Okay. Well, I think you look fantastic in the photo, but I will say when I was editing the photo, I said, please give Kim a little bit less hair. So that's probably what you're seeing.
So the truth comes out.
I love it. I
All
love
right.
it.
Well, great last question. So again, Kim, Jamie, thank you so much for the session and everyone who tuned in today with all of your questions and your insights. And as Jamie says, please get out there and vote. And thank you very much for joining us. And we hope to see you next time. So Kim, thank you again. Jamie, thank you again.
Thanks a lot.